Over 90% of world trade moves by sea, and Japan is home to 3 shipping giants that carry everything from cars to energy. NYK, MOL, and K-Line. These companies shaped the global trade boom, and their dividends shook Japan's market. But can they keep sailing ahead? Shipping is highly cyclical. During the pandemic, container rates soared to record highs. But since 2023, freight rates have corrected sharply, pressured by slowing global trade. Add to this climate challenges like the Panama Canal drought and new environmental rules that raise fuel costs. The seas are rough. First, Nippon Yusen, or NYK line. With a history stretching back to 1885, NYK is one of the oldest and most respected names in maritime transport, deeply intertwined with Japan's own economic modernization. Today, it's not just a shipping company, it's a global integrated logistics enterprise, commanding a vast and diverse fleet of over 800 vessels that connect continents and drive international trade. Its operations span everything from finished vehicles to bulk cargo, but its most significant recent strategic pivot has been in the container sector. In the turbulent mid-2010s, the container shipping industry faced a brutal downturn, culminating in the collapse of major players. In a bold and decisive move for survival and renewed competitiveness, NYK, along with its domestic rivals MOL and K-Line, made the historic decision to pool their respective container shipping divisions. The result, launched in 2017, was the Ocean Network Express. NYK holds the largest share, a 38% stake in this joint venture, and the gamble paid off spectacularly. One, with its instantly recognizable magenta branding, has rapidly ascended the global ranks to become one of the world's top container carriers, lauded for its operational efficiency and expansive network. This consolidation didn't just ensure survival, it created a formidable new force in global shipping. The financial rewards of this strategic alliance are substantial. In June 2025, one is set to pay over $732 million in dividends to Japan's shipping trio. For NYK, its 38% stake translates to a direct cash injection of approximately $278 million. This isn't just profit, it's a massive boost to its balance sheet, providing significant capital for debt reduction, shareholder returns, and most critically, reinvestment into future-proofing the company. And NYK is aggressively deploying that capital. Beyond containers, the company is making huge strides in future-focused sectors, positioning itself as a leader in the industry's green transition. This includes pioneering renewable energy logistics, transporting components for offshore wind farms, and preparing its fleet for the fuels of the future, like ammonia and hydrogen. It's also heavily investing in new, fuel-efficient vessels, from methanol-powered tankers to advanced LPG carriers. This dual strategy, optimizing its profitable container business while investing in sustainable next-generation logistics, defines NYK's ambitious path forward. Our third titan of the seas is Mitsui O.S.K. Lines, or MOL. With roots stretching back to the 19th century, MOL is a cornerstone of Japan's maritime history. Today it stands as a global powerhouse, but its strategy for navigating the turbulent waters of modern shipping sets it apart. While others chase the volatile spot market, MOL has charted a different course, one built on stability and long-term vision. MOL's strategic masterstroke is its dominance in the liquefied natural gas, or LNG, carrier market. As the world seeks cleaner energy, LNG is a critical bridge fuel, and MOL operates one of the largest fleets to transport it. The real genius, however, is their business model. Instead of gambling on fluctuating daily spot rates, MOL secures long-term charter contracts, often spanning decades, with major energy producers. This creates a fortress of financial stability, generating predictable revenue that insulates investors from the wild swings seen in other shipping sectors. It's a strategy prioritizing consistent returns over short-term windfalls. MOL's vision extends far beyond traditional shipping, as it aggressively invests in the green energy transition. They are a key player in the burgeoning offshore wind industry, providing the specialized vessels needed to construct and maintain massive wind farms. Simultaneously, they are pioneering the logistics for a decarbonized world by developing ships to transport liquefied CO2, a critical link for carbon capture projects. In a truly bold move, MOL has also taken a stake in U.S. firm Commonwealth Fusion Systems, a leader in compact nuclear fusion research. This isn't just diversification, it's a calculated bet on becoming an integrated energy infrastructure company. Finally, MOL is strategically deepening its roots in high-growth emerging markets, with a sharp focus on India. Recognizing the nation's trajectory as a future economic superpower, MOL is becoming part of the local industrial fabric. The company plans to expand its fleet using vessels built within Indian shipyards, a move that aligns perfectly with India's Make in India initiative. This local investment builds invaluable commercial capital, positioning MOL as the preferred logistics partner for India's soaring energy demands and expanding trade. Next is Kawasaki Kisen, universally recognized by its bold red logo as K-Line. Founded in 1919, K-Line has been a cornerstone of Japan's maritime trade for over a century. While once a major name in container shipping, a strategic pivot has reshaped its focus, allowing it to concentrate on specialized, high-value segments where it holds a distinct competitive advantage. A prime example is its world-leading car carrier division. K-Line operates one of the planet's largest fleets of pure car and truck carriers, a critical artery for Japan's automotive giants. As these manufacturers ramp up electric vehicle exports, K-Line's role becomes even more vital. Shipping EVs presents unique challenges, from their increased weight to stringent battery safety protocols. K-Line is meeting this demand by investing in next-generation LNG-fueled vessels designed for the future of automotive logistics. K-Line also has a strong dry bulk business. Its fleet is a workhorse of the global economy, transporting essential raw materials like iron ore, coal, and grains that fuel industrial growth. For an island nation like Japan, heavily reliant on imported resources, this service is a matter of economic security. While this segment is notoriously cyclical, K-Line's scale and long-term contracts with major industrial clients help mitigate some of that volatility. After years of restructuring, which included exiting the mainline container business to co-found the One Alliance, the company returned to strong profitability. For investors, the picture requires nuance. Its current dividend yield of around 4.4% is attractive, but it sits below the 5-year average, which was inflated by the post-pandemic shipping boom. The company's fortunes are now closely tied to the health of the global auto industry and commodity cycles, presenting both opportunities and risks. NYK, MOL, and K-Line all are highly profitable, but their strengths differ. NYK rides on container scale, MOL thrives on energy stability, K-Line bets on autos and resources. Together they remain Japan's dividend powerhouses, but volatility is always part of the voyage. For investors, shipping stocks are a double-edged sword. In 2021 and 2022, record profits fueled huge dividends. But today, the sector faces freight volatility, decarbonization costs, and geopolitical risks, from the Red Sea to the Taiwan Strait. Still, for income seekers, these names remain hard to ignore. Japan's shipping giants remain at the heart of global trade. The seas may be rough, but for bold investors, opportunity still awaits. Will you ride the next wave?